Hello everybody. So today I am going to cover EOS Energy and whether that's an investment that I would consider, whether it's a good investment or not. And this is a stock request from my Patreon, from the highest tier, and I am so thankful from the channel benefactor who decided to sponsor this video, because this is getting me out of my comfort zone. This is getting me to analyze companies that I usually don't analyze. Namely, this is an early company, this is a pre-revenue, this is a former SPAC, and I'm excited to tell you about it. And we're going to go through it and this entire thesis. Hopefully you find it interesting. I didn't have any preconceived notions about this company before going into it. In fact, I had never heard of it before going into it. So you'll get a full review of this company today. So let's talk about EOS Energy. What is EOS Energy? EOS Energy is in the business of aqueous liquid battery models. These battery models that kind of look like coolers, and they have a liquid, a zinc-based liquid that makes the bulk of the battery and the weight of the battery. And why would you want that? Why would you want to use a battery like this? Because they are obviously much cheaper to make, much cheaper to manufacture, much cheaper to buy. And so they are an alternative to lithium ion, because lithium ion batteries have historically been expensive. Another advantage of this type of battery is the modularity of them. You can stack them up and you can put them into buildings. And also they have a longer discharge duration than, say, the Tesla Megapacks, albeit you could oversize the Tesla Megapack and get to something similar, but they natively have a longer 12-hour discharge duration, which is another selling point that these batteries have. Now, why are these batteries an important sector, a major sector? Well, it's because of renewable energy. Because of renewable energy, you have a lot of energy that occurs in the midday, that is produced in the midday, yet we consume, and of course homes, consumer energy, right, is where the bulk of energy is still going to today. We'll see if AI replaces that, but of course these homes, they consume a lot of power at night when people come back from work, and that's when you turn on Netflix, turn on the lights, kids playing video games, whatever. This is where the bulk of the power is used. So these batteries, they're used to shift power from, say, the 2 p.m. sun and you and the 5 p.m. sun or whatever, and you take that sun and you can shift it 3 to 12 hours ahead into the hours of the night when the sun stops shining. So as soon as the solar arrays stop looking at the sun because it's night, these batteries kick in and they fill the gap in the grid. So that's why these batteries are very important for the grid. They're also going to be important for things like industrial applications such as electric buses, electric charging stations, electric trucks. These batteries are going to need to be present in a lot of these industrial facilities. There's a lot of opportunities to sell these products. I've covered the Megapacks before on this channel multiple times. This is going to be a big sector in my view. And so how does it work, by the way? So that's these bins right there, and you can see they're easy to manufacture. It's a fully modular design. They're manufactured in the USA, in Pennsylvania. They seal them, and once they are sealed, you don't see it on this picture, but you have two, or I guess you see them right there. You have two holes that you can connect your DC cable to. These are thick, bulky, heavy DC cable. You connect them through the cable. And the big advantage is that A, they last a long time, 20 years. So that's 5 years more than the Tesla Megapack, for example, here. And of course, whether it's that or the Megapacks, they can probably, both of them, last much longer than 20 years. Probably, but that's what they are rated as. They retain 97% of their system capacity above the 20-year period. So you only lose 3% of the total capacity. So it's a long-term thing. And they are non-flammable, which is, of course, a big selling point right now when it comes to batteries. Also, this company takes a green stance to a lot of the things that they do, and they emphasize the fact that it's ethical sourcing, mainly based on the fact that it's not using any lithium, it's not coming from the other side of the world, from unsafe mines. It's using materials that are local, that are much easier to get. That's for the thesis of this company. Now, what's interesting about this company is that they have the usual form factor, which is in this container, right? And this container would definitely be a direct head-to-head competition with, say, a Tesla Megapack or a Chinese Megapack. By the way, there's a bunch of Chinese Megapacks out there that exist. So that would be a competitor here. But I think more interestingly is that they're trying to work these batteries in a way that they can fit into architecture. And so this is an example of your typical American strip mall. And so you could have a building in the strip mall which is just filled with batteries. This is a bus station, and you could just have a building on the side that looks just like any conventional building, but it's filled with batteries. So they don't have that container look, that classic container look. They have the more architectural look, and of course that's maybe an advantage in cities. And maybe people in cities don't like to look at this. Maybe they prefer to look at this. That's one of the advantages, and they can be stacked and mounted to specific applications, right? And you can fit the specific need of the buyer that the buyer wants. You can fit that specific need. You don't need to have like the Tesla, which is they come in one big size, and that's roughly it. And how many you want to buy, right? They're modular at a more granular level, at a lower level. They're more nimble. I'm going to use the term nimble to define them. So that's interesting so far. Now, the channel benefactor asked me specifically to cover the competition, asked me what I think about the difference between EOS and the Tesla product in that space, which are the Tesla Megapacks. So I'm going to cover it. And what I have to assume, of course, is that EOS is executing, which you'll see in a second. They are ramping up. They're building the manufacturing. They're not there yet. They're not there yet, right? So it's a fundamental difference. Of course, the fundamental difference is that Tesla is selling the products right now. Now there's a wait list, but you'll see this company has a wait list too, and many companies in that field of grid battery storage have a wait list. But Tesla is executing right now. This company is ramping up the factory. So let's talk about the advantages. The chief advantages, and when this company was a SPAC trading at $10 when it was introduced and the company was much more expensive, they had a chief advantage, and I think they still have it somewhat, of course, but the chief advantage was that these solutions are much cheaper because you don't use lithium. And lithium, if you remember, the 21s, 22s, 23s, the cost of lithium went through the roof. And then come 2023, what did we see? Every legacy automaker stopped ordering lithium batteries. Right, and so now the prices of lithium have essentially collapsed, and we're roughly back to the level of 2020. Who knows how low lithium will go? In my view, a cheaper battery like EOS is less compelling when lithium is dropping. And we'll have to see the capacity for lithium, what it is in the future, and we'll have to see the lithium prices keep dropping. That is a threat to this company. If the lithium prices become on par and they become the same price, people may be more likely to go for lithium. So the advantage of cost here is more prevalent whenever lithium spikes in price. And so I would expect this company maybe to show some correlation, inverse correlation, right? An inverse correlation with the price of lithium because they don't use any. Now, a neutral factor, I think this is a neutral factor, but the size, these aqueous batteries, right, that work with these stacked bins in buildings, these aqueous batteries, they take more space. They take 2x more space than lithium. And of course, it's in some contexts, I think it doesn't matter at all in some contexts, especially if you're storing that near the photovoltaic area, near your solar fields. In that context, in my view, it really doesn't matter. It may, on the other hand, be a limiting factor if you have issues in the city, right? If you're trying to install that in the city, the fact that they take more space, assuming they were at the same price, that could be a downside. But EOS is dealing with the fact that these take more space with an elegant solution, in my view, which is to make it part of a building, part of a modern industrial building. Again, this is a neutral factor. The big factor, in my view, for the adoption of this is the cheaper cost than lithium. So that's why, if you own this company, you want lithium to go up, in my view. You want the cost of lithium to go up if you own this company. Now, let's talk about fire risk, right? And this is, of course, one of the favorite headlines of the media is to talk about Tesla fires. That always gets you click. That's one of the favorite headlines. And obviously, as you would expect, if you look it up, Tesla Megapacks on fire, that has happened. But when you read deeper into the report and go into the original report, what you find is that most of the incidents, they don't come from the cell themselves. They come from the power electronics, they come from the bus bars, the transformers, and so that means that the source of a fire for, say, a Tesla Megapack, that source would also still be there for EOS, because you're still going to need power electronics, right? You're still going to need a bus bar, you're still going to need these conventional electronic items, and yeah, they sometimes catch on fire. So the fire risk to me is, it's kind of not too big of a deal. Now let's talk about the 3 to 12 hours and the 2 to 4 hour application. EOS talks about how they have a longer discharge time, right, up to 12 hours. That's a plus for EOS. Now, my conversation with my AI today tells me that actually you can oversize Tesla Megapacks. And if you oversize Tesla Megapacks, you can very likely end up to a similar result by oversizing them, albeit that is not what they're designed for. They're designed for a 2 or 4 hour window, but you can probably do something like that. So there is some overlap, probably not a critical selling point. In my view, the biggest selling point is the cost. They're cheaper. Lithium needs to get more expensive for these to look like the deal of a lifetime, right? If lithium is cheap, these are not going to look like a deal of a lifetime. The price of batteries changes all the time based on the price of lithium. Anyways, and I'll conclude with that. In my view, grid operators, they will buy whatever they can get. There's a wait list at Tesla. There's a wait list in manufacturers of these. So they'll buy what they can get. And they'll buy EOS if they can get EOS. And I think that shortage is gonna last quite a while. At least that's my understanding of the market. This is a market that I follow very closely because of Tesla. Batteries will be in high demand for the foreseeable future, in my view. So if they can manufacture their own battery energy storage system for the grid, I don't think it will go unsold. And guess what? Their order book agrees with me. They have backlogs, binding agreements, orders in hands of 586 million. So that's roughly their entire, that's a little less than their entire enterprise value, but let's round it up and say it's roughly their enterprise value in backlog. So yeah, they're late. That's when they sign it up, but it's like they got to deliver now. Now they have to deliver. So there's lots of orders and people are waiting, but there's execution risk, right? You have to execute, which means that you have to ramp that manufacturing, and manufacturing is hard. To quote the CEO of a somewhat competing company, manufacturing is difficult, execution is difficult, they have to manufacture a product. Think about the booked orders, right? This will be added on top if those manifest themselves, and then you have a commercial pipeline. This represents a lot of their proposals that they make to different entities who want to buy the stuff. Of course, the revenue is not worth commenting on right now. This is a pre-revenue company. Let me make that disclaimer for the first time. I'll make it again in a second. I am no expert in pre-revenue companies. I exclusively buy companies that are later in their product adoption cycle. This company would be too early in the product adoption cycle for me, because the product adoption is there in terms of backlog, but it hasn't been booked as revenue. So I try to invest in companies that are later on, and that's because I'm in my mid 30s, and in my mid 30s, obviously, to me, this is on the edge of risk. This is riskier. This is a riskier company, and so it's like I'm not a venture capitalist. To me, this is riskier. So just putting that out there. So that's point number one. Now that that I'm no expert in pre-revenue company, let me tell you what happened. So of course the stock was trading. It went down to 69 cents. at one point, then went back up to roughly $1. It was trading like a company that had very little cash left, and because it's obviously what it was, and the market was like, okay, well, this is a pretty risky business. They have very little cash left. Are they going to go under? What's going to happen, right? And as happens oftentimes in these companies that are cash strapped, but that are pre-revenue, i.e., that don't have any sales yet. What happens is you have a quote-unquote strategic partner come in. The strategic partner that EOS Energy found is Cerberus, which is a kind of a large alternative asset manager or VC type company. And they did what I'm going to call a cash infusion. They did a cash infusion of $220 million to be disbursed based on achieving milestones. So this is something very common in the VC industry. They do that quite a bit, right? Yes. And they also have a revolver, like a line of credit. So what did we see after that cash infusion? As usually happens when companies are so depressed in terms of pricing, and all of a sudden you have quote-unquote a savior that comes in and puts a bunch of cash in the company. Well, it was up 158% in 3 months. Yeah, that's an outstanding return. This is almost a crypto-like return. Kudos to you if you bought it at $1. Even more kudos to you if you bought it at 69 cents. Now, of course, could you have seen that coming? Could you have seen coming that they would have had a strategic partner? Well, this is what I want to make clear in this company. Is they got a partner. Some companies that I follow a lot of companies. Some companies do not get partners. There's a lot of biotechs that have died because they haven't gotten a partner because of the Fed's effort to hurt the funding environment. When this company went public as a SPAC, they were hearing the Fed saying, we're not thinking about raising rates, and they reached a valuation close to $20 a share, right? Keep in mind, it's running at $250 now, so 10x less than the top. And they likely thought, oh, we're going to do multiple rounds. We're going to do another round of funding and another round of funding and sell more stock. That's the environment these companies went public for. I do not think a company like that would go public today. And the Fed, the Fed did this, right? It cut the liquidity because how do you hurt the economy to stop inflation, which is what we're trying to do, right? Stopping inflation by hurting the economy. Well, when you have thousands of later stage startups, when you have thousands of later stage startups like that who go bankrupt because of the hard money, because of the hard fundraise environment, well, you're creating a recession because all of a sudden the people they hire, the investment they make are not happening, and you're cooling off the prices. This is one of the many companies that was hurt by the sudden change in the financing environment. So once again, I am no expert on pre-revenue companies, but based on my experience, they got very lucky to get this investment when they did, which means that they were able to convince an alternative asset manager that this was good enough. They were able to convince, I can think of formerly major tech, especially in the biotech sector, who didn't get that funding. That used to be like $20 billion company who just went out because they couldn't get the next round. And of course, when these companies went public, they were thinking it would be easy to raise the next round because nobody expected the rates to go up so much when you have the head of the Fed tell you not thinking about raising rates. Anyways, I'm done with the tangent. Now that I've told you that I think they got lucky to get funding, let me tell you one more thing, is that's expensive. That funding is expensive. Keeping in mind, once again, that I am no expert in this type of deal, and in pre-revenue companies, I am no expert, but I like to think I can read a SEC 8K statement. I like to think that. And so if you're curious about the $200+ million, I'm not talking about the revolver, but just the $210 million. If you're curious about the interest rate, that's 15%. Yeah, that's what you get in this environment. What can I say? That's what you get in this environment. That is high, but that is reflective of the risk and reflective of the interest rate. So that's a hefty interest rate, right? 15% for a company that is what was founded in a zero interest rate environment. That's a hefty interest rate, but that wouldn't be the problem. right? The bigger problem is that they had to give up 33% of the shares in the company, right? They had to give up 33% of the company to get this, and if they don't achieve their milestone, or if there's issues, it could cost them up to 49% of the company. And I've just zoomed that for you. This is the SEC filing. Feel free to read, right? When they got the funding, they also got the warrants, right? And the warrants are for 33% of the business. So there could be more dilution coming, 33% I just mentioned, but especially if they don't reach some milestones, there could be more dilution coming. As you know, dilution doesn't upset me too much for companies in general, because the dollar is getting diluted, but that's a lot of dilution. The question is, are they going to make it, right? If they make it to $100 billion company in 10 years, we won't care. If they don't, well, guess what? It's like there will be just pennies to pick up. So at this point, they did it. They had to do it because the other alternative was the company not going forward because they were founded in another area. It's sad that we have to talk about that, and we can't just talk about technology, because the tech seems really good, and the tech seems like they have a lot of patent. It's compelling. I love this idea. Actually, I don't like it. I happen to think the future, perhaps, of individual homes is based on having maybe 30 of these in your basement. That's what I happen to think. Or these, I think, are going to be very prevalent. It's an innovative product. I'm very happy to see that done in the US, but because of the funding environment, we have to worry about we have to worry about that stuff and the dilution, and yeah, that's a strategic partner, but that's an expensive strategic partner. I just wanted to point that out. Again, no expert in pre-revenue companies. My companies, usually they're optimized for gross profit, and they usually don't lose a lot of money on an EBITDA margin basis. So you'll see these companies actually not optimized for gross profit yet, which is normal for a pre-revenue company. So let's talk a little more. So the money, right? So they got a bunch of it up front. They just achieved a milestone recently on August 29. They achieved their first milestone, the performance milestone, to get the money released. And so that means they got $30 million that they can draw on the term, and they have two more milestones, one for $65 million, one for $40 million. That money is invested in the plant, right? And once you've reached the new milestone, you get to invest more money in the plant. And you reach the new milestone, you get to invest more money in the plant. This is how VCs disburse their money. Very common. So the point is to access that money, right, and start paying the interest and all that stuff. You need to do well at the execution. Execution is key. How is the scaling going? It seems like the scaling is going fine. To the best of what I can tell, it's going fine. I mean, if you feel free to read. I wish they told us a little more about the scaling than just this one slide. It'd be good to spend a little more time talking about it. I actually was planning to show you more of the scaling, but apparently the scaling is going fine. I went on the hiring website, and they're hiring a bunch of people for a manufacturing facility. So seems to be doing fine. So we'll see. They definitely need to communicate on that scaling a lot, because that's key to understanding this company and assessing whether this company is good or not. Is the scaling. So they should focus on the scaling, right? They should focus on that a lot, communicate on that a lot. But they're doing that. They just communicate that. So it's good. Okay. Let me move on to the scaling is good, right? So let me move on to now the backlog. So the backlog is $586 million. Again, it went down a little bit over the prior quarter. Anyways, 3% is not that meaningful. I mean, this is like I said, this is roughly their enterprise value, likely more than their market cap right now that they got that much debt. And again, that means they're going to be able to ship these products as soon as they ramp. To access that, they need to ramp. They have some prepayments, but they need to ramp. They need to ship. This is prime time for this company. And you can see their lead generation here is when they do proposal, feasibility studies, etc. It's a long selling process, but good for them to have this many sales. And of course, let's assume a lot of these leads and a lot of this commercial opportunity keeps turning into backlog. That means they're going to have to keep expanding those manufacturing facility. To quote Elon Musk once again, manufacturing is hard. And so to scale, they're going to need more funds. Of course, they got the term loan, the loan from Cerberus, that the money they can access in the future. So that's one aspect. Then they have a revolver that they can still draw on. Then, and this was interesting, I didn't know about this, they can get preferential financing from the government as it's called Title VII Clean Energy Financing that they can get. Again, I think this is part of the IRA Act. Watch out for the election. You don't know, whenever there's a green stock, people may say, oh, what if they remove those programs because maybe a political candidate is less suited to helping out green, quote unquote, green companies. So that could be a risk, but nonetheless, it's pretty high. They could get 400 million financing in preferable terms, and these terms typically, borrowing money from the government typically tends to be preferable. And of course, they're going to have customer deposits. They hope to monetize some production tax credit. If you follow my videos on Enphase, you know that's a big part of manufacturing in the USA. Is you just get a lot of money. To quote the CFO of Enphase, one of my favorite quotes from a CFO: "Direct pay IRS," as she said in the Enphase. So we're gonna get some direct pay money through this tax credit probably. So that's pretty good too. But you can see there's a lot of money. More money is going to have to be spent on the manufacturing, and so they have to scale. They have to ramp that manufacturing. Manufacturing is hard. Let's talk about the income statement. Really little to no sales to speak of so far. It is normal for a pre-revenue company. The problem, of course, is that when you sell 900,000 and you have 14 million in expenses, well, I get a very, very, very negative gross margin. I can't really calculate the gross margin for you because the number doesn't make sense because it's too negative, right? So you would be what, at minus 1,400% or something like that. It's pointless to calculate it. So they are not optimized for gross profit yet. We can't look at any of that. We can only look at the addressable market. The addressable market is huge. Check. Now we turn our attention to their execution. Are they going to be able to hit those execution targets? Operational leverage, EBITDA margin for this company, that's probably a 2026, 2027 story, maybe sooner, but they really got to ramp, right? They have to ramp manufacturing. So that ends the risk, right? It's a riskier company. So let me conclude. And again, my tools, my frameworks do not work when I analyze these companies. They just don't. They just don't. So that's why, let me tell you right now, for me, this is too risky of a company. I do not invest in companies that are so far out on the risk curve. I think it's a company that's more far out on the risk curve. So for me, I'm not equipped to analyze it. And the famous quotes: "Don't invest in what you don't understand." I can understand technology. I can understand a lot of the financials, but pre-revenue company is a specific style of investing, which is what would be, for example, the Cathie Wood style of investing. Cathie Wood is very good at that. Me, I'm not that good at it. So the point is, let's assume they're gonna sell 300 million next year, right? Or like the next 12 months, right? Next 4 quarters. So I take the middle point of what they're telling us in Q4, and I multiply it by 4, so that's 300 million. So let's assume we're going to do 300 million. If you turn that into like a rough revenue growth number, that means the company, and I'm assuming they did like about 4 million, so that means the company would go from 4 million in sales in a year to by 7,500%, right? 75x. So you would have an insane increase in sales, and the gross margin, in Q4, that means in Q3 we're still going to have a negative contribution margin. I'm using contribution margin as a sort of a proxy. I'm going to assume the gross margin is just going to be a break even, so I'm going to assume 1%. And you can see I get a high EV over GP over RG, but again, that doesn't make any sense because my usual spreadsheets for analyzing stocks, it doesn't work for pre-revenue companies that are not optimized for gross profit. It doesn't work for banks. There's a few other types of companies for which it does not work. So for this type of company, we can mostly rely on qualitative analysis. What do we think of a technology? What do we think of their execution and how well they're executing? And that's why it's riskier. It's riskier. It's riskier on the curve. So anyways, I was still very happy to analyze it. Thank you so much to my Patreon benefactor who sponsored this video. This is a video I would not analyze for the channel if it were not for them. So thank you so much for them. Thank you for registering to my Patreon and suggesting this video. I learned a lot. I did not know about this type of battery. I'm glad I do. Thank you for the sponsorship. By the way, my Patreon is launched. I share my spreadsheets. Anyways, all of the premium content that I have, I'll throw on the Patreon, and I have started throwing on the Patreon, and we have a private community, of course, with the Discord, and I am active. I've installed the Discord app on my phone, and I intend to be fully active and interacting with my community. Thank you so much for your support. Thank you so much for watching. This is no financial advice, no investment advice. This is just entertainment. Please like, please subscribe. Have a wonderful, wonderful day.